On November 14th, we saw the latest read of the much anticipated U.S. CPI report. Now, it came in lower than expected on both the headline and, more importantly, excluding food and energy. Now, the broad market reaction was fierce as risk assets like stocks screamed higher and yields fell. Now, one move that most did not expect was a swift 4.5% decline in Bitcoin. Now, the forces that have been pushing Bitcoin higher throughout the year are still in place. That includes institutional adoption and the anticipation of the approval of a Bitcoin ETF. But many thought that a decline in interest rates would be an additional tailwind for Bitcoin and all non-yielding assets. It wasn't. Perhaps some of the broad strength in Bitcoin throughout the year really was a hedge against an eventual economic downturn caused by higher rates, and now that inflation seems to be moderating, there's perhaps less need for that hedge. Of course, the move could just reflect overweight market positioning and doesn't necessarily have to have a deeper meaning, but it's certainly worth watching. Now, the CME has recently launched options on both the micro Bitcoin and Ether contracts. We're going to be using the micro futures for these examples. If a trader believes that Bitcoin will move lower from here, they could express that by selling the November micro Bitcoin contract at $36,550 and targeting a move to the October 27th low of $33,450. A stop for this trade could be placed above at $38,500. This trade can make $310 if the target is reached and risks $195 if you're stopped at your level. If a trader believes Bitcoin will trade higher from here, they could buy that November micro Bitcoin contract at $36,550 and target a move to the psychological level of $40,000. Now, a stop for this trade could be placed below at $34,800. Now, this trade could make $345 if your target is reached and risks $175 if you're stopped out of your level.